Hi, this is the Doctor from FX Signal Trader. Today's video is about some of the fundamentals of the different brokers, the bid and ask prices, margins, and many other things. It can be extremely confusing. Even if you're an old hand at it, it can still be confusing. So this video is dedicated to trying to sort some of that out. You may find that even after this video it's not at all easy to understand. It does twist your mind. All I can suggest is that this video will contain all the information you need to understand everything, but you just need to sit down with maybe a blank piece of paper and go through it in your own mind and your own logic, and it will suddenly click with you and you will then be an expert. So let's get cracking. Here you can see a chart. Any chart on any platform, a price being read on that chart reads 65.20, which is the peak here. Now, each broker has their own particular way of displaying chart prices and what they relate to. The vast majority of brokers tend to use the default that what you see on the screen on the chart is the sell or bid price. This means that if you wanted to sell at 65.20, when this chart got to that price, you would be entered into that contract and be selling the market at that price. However, if you were to enter an order to buy at 65.20, when the actual chart got to that price, you will have already noticed that down here at 65.16 you would have been entered into that buy. Now, why is this? It can be very confusing. Well, it's very simple. Brokers make their money by charging a spread. So if you were to buy at 65.24 and immediately want to sell, you would have to sell at the 65.20 price. So they would make the 4 pips out of you. This is the way everyone makes their money, and you can't begrudge them of that. Obviously, some brokers are better than others, and the spread will fluctuate and be completely dependent on your broker. Of this we can't control. Some brokers have a fixed spread, other brokers vary their spread dependent on the liquidity in the market. Some brokers around the news releases might widen their spread to ridiculous values like 15, 20, I've even heard 30 pips mentioned. So you have to be on your toes. But generally, the times that we're trading and entering the markets, we're not near news times, so the large widening of spreads doesn't come into it. But potentially you could be in a trade that is fairly close to its stop or profit target, and if it's near the news and your broker is the type that increases their spread hugely, then you could get prematurely stopped or just out of the trade because of that. So we can't control these situations. Nobody can. We just have to live with it and do the best from my experience. So I was explaining here that the general rule of thumb for the majority of brokers that I've seen and come across are that the charts always represent the sell or bid price. So whatever you sell, you will get at whatever you see here. However, whatever you buy, you will get 4 pips underneath on this chart. And that might explain some of the funny things you may have been seeing previously. You may be entered into a trade where you thought it still had to move 4 pips. Well, the simple reason is you haven't allowed for that spread that your broker's asking for. On MetaTrader, you can actually display both the ask and the bid price on your chart, so that should help you, but you just need to be careful. TradeStation also uses the default of charting the bid prices, and absolutely every single price that we state on our signal screen, giving you the prices, is always the chart price. So it's always the bid price. It's never anything else. So let's take an example trade and see what you would enter. Okay, here we've got an example signal coming in to buy the market at 65.20. So what do we do? As I've just explained, 65.20 on this chart is this level here, but this level here is the bid price. If we want to buy the market at this level here, which is what we've asked for in this price here, because this is the selling price, we have to account for the spread in our broker. So to ensure that we enter the market when the chart physically reaches this level, we need to add 4 points, or 4 pips, onto the 65.20 level. So we would enter a buy order at 65.24, not 65.20. If we entered a buy order at 65.20, we would be filled at 65.16, which is down here somewhere. Now, conversely, if we had a sell order at 65.20, what would we enter? Well, it's very easy in that case. We know that the charts always show the sell prices. So if we had an order to sell at 65.20, we would put in exactly 65.20 without any adjustment. So all sell orders you put in exactly as we provide to you. All buy orders you put in at the buy price plus, in addition, the spread. You can see the spread very easily at your broker because it's the difference between the bid and the ask price. That's all you have to do. Just look at it, see what your spread is, and add it on to any buys. Now you also have to apply this rule to all the orders. So a stop order, for instance, this stop order here would be taking us out of the market by selling what we originally bought. So this price is a sell order, and as we've just learnt, the sell orders go in exactly as they are. So the sell price is 164.95. Similarly, the limit, the profit target for a buy order, is still exiting by selling your initial position. So the 65.95 is exactly entered. So both the stop and the limit on a buy trade are entered exactly at the prices that you see. Everything works the complete opposite way for a sell order. So if we're selling the market, we'll be entering exactly 65.20 here, but because we'll be buying back to close our positions on a stop or a profit, we'll be adding to the prices provided here by the spread, which currently was 4 pips. Now it's as simple as that. Hopefully that dispels all concerns and worries for the future and clears up some of the questions that we've been getting. Obviously there are other things that come in, but that will complicate things if I start talking about them now. Make sure you understand this aspect before you start trying to understand other aspects. As a brief intro to that, it's essentially that all brokers have different data feeds. Well, groups of brokers use different data feeds. Those different data feeds inherently will have deviations in their pricing, irrespective of spreads. So that, yet again, adds room for some minor discrepancies between the different brokers. And again, we have no control over that. It will happen wherever you go and whosever signals you follow. Hopefully it will happen rarely. The majority of the issues are essentially circumvented by using what I've just taken you through, by adjusting for your spread. So I hope that was useful and good trading to you. Cheers and goodbye.